As you can see, we got a little bit of green. See how long that lasts for on the markets and what options are saying about equities. Let's bring in Amy Wu Silverman, head of derivative strategies at RBC Capital Markets. We don't want it to be obvious. It is, but it's so important, and it's the beginning of the year. Seasonality plays a big part in how options behave and how markets behave.
Yeah, it totally does. And I agree. It feels a little bit obvious, but it doesn't mean that doesn't end up being what happens. Yeah. Joe, when you just look seasonally last 5, 10, 15, 20 years, January is not a great month. It tends to be a month where you get VIX rises and market sell-offs. You know, I kind of like to joke it has a little bit to do with New Year's resolutions. The portfolio managers out there all say we're going to be more disciplined, we're going to be more cautious. And then, 3 months later, some FOMO momentum takes the wind and we can throw that all out the window. But right now, not as much of a sanguine outlook as when we started the beginning of December.
Tried to talk about resolutions right at the beginning of the show. No one wanted to talk about resolutions. So even you are bringing them up as something that affects trading, because even market participants, in the way that they trade, they start the year and it lasts how long? 10 days. 10 days. I think
it's the same as the average diet.
There's an actual day, if you look it up, I guess. I've seen it on a commercial where people give up on their New Year's resolutions. You do point out that the risk has not been a market sell-off, but in missing out on upside. That's the way it has been. Is that the way it's going to be?
So every year we get another 20% rally in the S&P. I'd say your baseline makes that a little bit tougher, but I wouldn't count it out. And one thing we've seen post-COVID is that right tail risk has been just as serious as your left tail risk. Now you throw into this year the deregulation potentially around cryptocurrency, around financial regulation. And I think if you look at the consensus narrative right now among derivative strategists, it's that volatility is too low. VIX should be more reactive on the downside. I'm not saying I disagree with that. I just think we have to continue to pay attention to that right tail, because when that spirals, you get that volatility up, spot up, just like we saw in 2023, just like we saw in 2024. To me, those odds are just structurally different now than they were pre-COVID.
So Quitter's Day is coming up. It's this Friday, the second Friday in January is when people traditionally give up, or most frequently, because they haven't thought through like the longer term implications. Yeah, I can do this for a week or two.
To options traders too.
We'll see that during earnings season when that benchmark FOMO, that need to participate, starts to overweigh your valuation discipline. I think one of the big themes everyone keeps talking about is we need to see a market breadth widening. But, we're still suffering through the same paddling duck market. I like to call it that because it looks smooth and calm on the surface, right? But you've gotten these huge violent rotations, maybe down in healthcare, up in financials. And so that index level volatility continues to look calm. Your VIX isn't really signaling much. But you throw Donald Trump into the mix and the changes in fiscal policy, and I think that dispersion is going to really impact the market.
Mergers and acquisitions are probably going to be back. You say at this point it's not priced into the option market. Why not in the option market? Why not? Everything else gets priced into the option market. Why is this not priced in? And should it be? Or is the option market right and it shouldn't be priced in?
So I think this is one of the most interesting opportunities in options. And one of the reasons I think it hasn't been priced in is the last time you saw a really big M&A wave was actually like around 2010. So it's almost like the wheels are a little bit rusty for the folks who haven't gotten on the bike for a long time. And this is kind of a unique pocket, right? It's not like other themes that happen every single year. When you think about the wave of M&A, that usually gets priced in the options through term structure, so how the future looks to the present, and through skew, how the downside looks to the upside. Neither of those are pricing in any wave of M&A, and yet we've been talking about it for a while. So to me, one of the biggest deployments you could do is using option strategies to play potential M&A.
So it's coming then?
It's not priced in, but if it does come, that's an opportunity to use options to leverage those M&A scenarios.
Let's go back to, just so I understand it maybe a little bit better, the divergence between the volatility in equities versus rates. Can you explain that to me so I understand it better?
Yeah, so when you look at all different kind of instruments, you have Treasury volatility. You can use the MOVE index as a proxy for that. You have equity volatility. You can use VIX as a proxy for that. We measure the ratios of those divergences. So meaning when you see equity volatility pretty sanguine, but then rates volatility is quite high, you know, we're talking about the same market. So somebody is right and somebody is wrong. And one of the reasons we like to use those cross-asset metrics is you could argue that rates is driving everything, right? Rates isn't just driving the rates market. Rates is driving every single market. So the big question right now is why is the rates market saying there's more volatility and uncertainty ahead relative to the equity market? When you backtest that over time, someone's right and someone's wrong. It has not always been that the rates market has been right, but usually those divergences happening means one of the narratives has to fall in the next few weeks.